Good morning and welcome to our weekly mortgage market update. Please let me introduce the president of camp, Ms. Audrey Boyce-Snow. Audrey?
Thank you so much and good morning, everyone. Thank you for joining us. A big thank you, as always, to Megan Jackson, who you just heard. She is very, very important with putting these together. And to Kevin Casey, our upcoming president-elect for camp. Really appreciate everyone's help. A few little housekeeping details before we get going. First of all, we just had a very successful 20-hour pre-licensed NMLS class with 29 attendees the other day. So there are people who, despite all this crazy, want to get into the business. We'll be doing more of that. And on May 15th, we have the NMLS Continuing Ed for 8 hours with Dave Luna. And then on May 28th, we're going to do another round of that with Kevin Casey teaching it. So we'll look forward to people signing up for that. And we'll probably put together another 20-hour class just because they are very popular right now. Just a reminder that we will take questions. And if you've been on the call before, you know the drill. Just put your questions into the chat bar and we'll get to them as the conversation goes forward. So we have 4 amazing gentlemen who are joining us today. Another little note for next week, or upcoming weeks, Dave Luna, that is going to be back by popular demand. He had done April for us. He was a little tired, took a little breather, and although he's moving today, has joined us for today and will continue to do that for the month of May. So thank you, Dave Luna, who's with us today. And then we have Kevin Peranio and Jeff Pancer and Carl Markman. So gentlemen, thank you so, so much. We're going to start with Dave Luna giving us a little update and recap of the week, and then we'll launch into some other discussions. So David, nice to see your face. Take it away.
Thank you. Good morning, everybody. I didn't want to take away from just the powerhouse speakers that we have with Kevin, Carl, and Jeff. So my segment is very, very short. So the CEO of MBA said Fannie, Freddie, and FHA are working with lenders to make it easier for borrowers to get current on their loans. So just like we saw that FHA outlined certain things that people could do, you'll see an announcement in the next 2 weeks, so that borrowers can see that they have options to get themselves current, looking at the tremendous percent of individuals that are in this forbearance period. He said, hopefully this new option will not be overly complex and can work for a lot of borrowers. Mortgage rates fell to their lowest level since Freddie Mac started reporting the data in 1971. So the coronavirus shutdown has continued to play havoc with the economy. We'll see what happens. Several lenders are jumping back in on cash out refis, but it's going to be a 500 basis point hit for you math people. If it's a refi cash out at $500,000, say Southern Cal or Northern Cal, that's going to be an additional cost or hit of $25,000. Okay, the FOMC, the Federal Reserve, met last week, left funds rate exactly the same. Their statement, however, was of interest to me, even though they didn't drop rates. I mean, you're at between 25 basis points and 0, so you're at 0 basically. You know, it said the Federal Reserve says, quote, the committee expects to maintain this target range until it is confident that the economy has weathered recent events and on track to achieve its maximum, employment and price stability goals. In determining the timing and size of future adjustments to the stance of monetary policy, the committee will assess realized and expected economic situations relative to its maximum employment objective. They said it twice, and it's 2% inflation objective. So, you know, it looks like we are not really dealing with hyperinflation or any kind of major inflation for the next little while. And again, what their actions are trying to do is make sure that we can hit employment objective targets. From the CFPB, and a question for Jeff, Carl, and Kevin later on the 29th, the Bureau issued an interpretive rule clarifying, listen, that consumers can exercise their rights to modify or waive certain required waiting periods. In English, they can waive rescission. They can waive the 3-day wait time on CDs, okay? And so I'm going, whoa, I haven't seen that like in 30, 35 years. So the Bureau is also issuing an FAQ document that addresses when creditors must provide appraisals and other valuations, again, because of the COVID pandemic, and because I want to give plenty of time to our guests today. I'm going to reserve my questions for the panelists after they've had an opportunity to visit. So Audrey, turning time back over to you.
Thank you, David, as always. Always good to hear from you. So, gentlemen, does anyone have anything they'd like to share that's happened in the last week that would be interesting for us to hear? Really? All at once? Come on, guys, unmute. Okay. Does that mean that David handled absolutely everything that's happened in the last week? That's amazing, David. Good job.
No way. No
All right.
way. I have some questions for these guys. I've got some questions.
Yeah. All
I'll
right.
chime
So
in.
let's get into that then. Oh, there's Kevin Peranio.
I think.
Hey, Pete,
all
did you
three
want to say something?
Yeah, I think all three of us wily veterans were jockeying for last word and didn't want to go first, but I'll jump in. Yeah, David, thank you for the opening comments. My name is Kevin Peranio. I'm Chief Lending Officer and one of the 4 owners at PRMG. I'm super excited as a California-based lender to be on this call and supporting our membership, and of course anyone outside of California that's listening. And Jeff, I don't know other than on this call, but I've read up on his bio. Super strong professional. And Carl is my boy. He and his team are growing, and I love it. There's a lot of positive takeaways, I think, right now in the industry, despite some turbulence that we're all facing right now. And so, David and Audrey, thank you for the setup. Happy to talk about anything you want to go over, anything specific. There was a lot packed in there that you brought up, David: the cash out hits, the forbearance policies, servicing protocols, MBA lobbying efforts. There's so much in there we could talk about. So, I know I'll let you steer the conversation.
Let's just take it one by one. So let's just start with cash out. Everyone wants to talk about cash out. How is that going? What's going on? Tell us.
Sure. So I'll just chime in since I'm yapping away here. So the cash out policy that came out from FHFA is interesting. And basically, the director, Mark Calabria, and his team, who are the governing body over Fannie Mae and Freddie Mac, specifically said on cash out loans that go into forbearance before Fannie or Freddie has purchased them are ineligible for purchase. So depending on how a Fannie Freddie seller pulls their securities together will dictate what their policy will be on the front end. And so I want you guys to understand there's different ways that people sell loans to Fannie and Freddie. So a lot of the larger aggregators, they pool gigantic securities, huge pools at a time. And so they have a longer time from the point at which a loan funds, a cash out, to the time it actually gets sold to Fannie or Freddie. So that longer period is obviously longer risk for a borrower to go, hey, thanks for the cash out. Oh, by the way, I'd like my 12 months free payments, no questions asked, no documentation required, please. And so that risk for those larger lenders is greater. Now, most smaller lenders, and I would consider us a smaller lender, we sell to what's called Fannie Freddie's cash window. So we fund a loan, whether in our wholesale channel, our correspondent channel, or our retail channel, and within days, usually not more than 1 week's time, we're selling into the cash window. So we're placing this into a Fannie Mae or Freddie Mac security. So our window of the time at which a borrower closes funds and then turns around and asks for forbearance is extremely small. So for us, we don't think the risk is enormous, but as a whole in the industry, not everyone delivers in the cash window. So a lot of people are saying, hey, this is a risk. And it's uncertainty. We don't know. We don't have the data of cash out borrowers asking for forbearance after closing and funding. So people are kind of erring on the side of caution. So they're adding cash out hits to the rate sheet to offset modeled in or anticipated or expected losses for loans that they close and fund that they cannot sell. You have to understand, you can't sell this loan to Fannie or Freddie. They're saying, we will not buy we will not buy a cash out loan that goes into forbearance before you sell it to us, even if they ask for forbearance, which is allowed per Congress in the CARES Act. So the only lender that does Fannie Mae and Freddie Mac loans is saying we're not going to buy a loan that's allowed to be in forbearance per our own nation's Congress and presidential CARES Act. So what happens is if you get stuck with one of those loans, you have to go sell it and scratch and dent. You could maybe take a 20% hit, 10% hit, depending on which scratch and dent seller you sell to. So people are modeling in the cost of a potential loss for loans that fall into that forbearance window. And everybody has different hits on their rate sheets. Some have no hits, some have 50 basis points hits, some have 9-point hits. It just depends on who you sell to, what the LTV and FICO. Lowest LTV, or excuse me, 80% LTV, 620 FICO, I think that's your max on both ends. So you're going to see some massive hits potentially on some rate sheets. So that's kind of the whole cash out thing. I mean, it's still out there. It sucks. I mean, you know, last time, I mean, just my opinion here, I'll interject just to throw some sizzle in here because you know that I will. It's interesting that Fannie and Freddie, which are government-sponsored enterprises in conservatorship in this government that we all pay taxes to, that has to adhere to the CARES Act, which is U.S. law, is refusing to buy loans in this system if someone's trying to tap into equity and then claims the free lunch that was given to them by the CARES Act and not buy it and causing disruption and credit tightening. So I just think it's a crazy scenario, but that's kind of how I see it.
Okay, so can we take a moment and think about the CARES Act? So there are dates associated with the CARES Act, correct? So there are certain time periods where it started where they could ask for forbearance and then it ends, right? What is the end date on their ability to ask for a forbearance? Does anyone know the answer to that?
No,
Okay.
But I can tell you we're coming up on the anniversary of the first round of loans that went into forbearance, right? So the first round was given 90 days forbearance initially, and we're coming up on that pretty soon, and we're trying, and you know, everybody's trying to figure out what happens to those borrowers. Initially, the plan was to have them make 4 payments at once and catch up. Obviously, you know, most borrowers aren't going to be able to do that. So do they get extended? Do they go into a modification? Does it get tacked on at the end? And I think that's what Dave was alluding to earlier is we're not sure what, you know, what was allowed. We're seeing some guidance on that with servicers, but you know, that first group of borrowers that are just coming up on their 90-day windows next month, it's going to be interesting to see, you know, how those are taken care of. Initially thought, you know, when they first came out, you know, forbearance was forgiveness, and then everybody, you know, kind of backtracked on that and said, no, that's not really the case. So that first round of borrowers may be in for a little bit of a rude awakening, and let's see what happens in the next couple of weeks.
So are they getting some sort of document in writing where it outlines the terms that they agreed to so that they, I mean, are you getting any sense of what kind of information the borrowers really are receiving and how well they're understanding it and digesting it? Because again, I think it was a conversation I heard Kevin having with some other group where they talked about how you've got the forbearance period and then, you know, there's a realization that most people aren't going to be able to come up with the full 4 months or whatever period of time it was. And then it will need to be a modification of sorts. And then what happens with the credit? So once it's a mod, then what timelines are we subject to with regard to them being able to get another mortgage, potentially either a refinance or a purchase? You know, what are the ramifications around that? I would love to hear your insight on the credit aspect of that and what you think is going to happen, or if you have plans in place already that you can share with us.
Well, we're not quite sure if it's going to impact your FICO score. Obviously, modification would, but it will show up on your credit report when it's pulled that you were in forbearance, and that, you know, that could raise some questions with an underwriter if you're trying to refinance or purchase a new home as to what was your situation and what is your, you know, why did you need the forbearance? What did you request it for, and how did you ultimately resolve it? You know, those are some of the unanswered questions that we're remains to be seen, but it is going to impact future borrowers, whether it be through FICO or just how it appears on the credit report.
Yeah, I think a lot of loan officers these days are actually educating our borrowers and talking to them actually what the ramifications are. So a lot of people that were, even though the percentages are high right now, Jeff, you and I were talking right now, we're in the range 5, 6, 7% of servicing portfolios. It would be even higher if the loan officers out there weren't educating the borrowers. So a lot of people actually are attracting the forbearance requests that we're seeing right now.
That's a really good point. I've seen a lot of that too, where loan officers are really trying to spread the word as far as make sure that the borrowers are talking to their servicers individually to find out what their particular situation might be. Yeah, it's fluid. Then you guys don't have a plan in place yet either, it sounds like, because how could we? So we're working on. Sorry, go ahead.
Yeah, I'll kind of jump in there. I mean, I don't think that it's a matter of having a plan. I think it's a matter of getting more clarity from FHFA. And so as it relates to forbearance, look, the rule is very clear on how a creditor is supposed to report borrowers in forbearance. They are supposed to continue to say paid as agreed. Okay, and the only thing they're allowed to put is a note that will show up on the credit report that says deferment. Now, obviously, that's going to be a red flag. And if this, I'll give you an example. We had a loan last week where a borrower asked for forbearance from their bank. Their bank reported it as in forbearance, which they're not supposed to actually do that, but they reported it as in forbearance. The borrower went ahead and made their April payment and said, you know what, I think twice on this. I'm not going to let this hurt me. And then came to us. We pulled their credit, ran to you to do a refi, because the bank in error, number one, reported it as in forbearance, which they're not supposed to say in forbearance, and then didn't remove it because the person made their April payment. It killed their deal in DU. And so there's going to be a lot of situations like this come up. And to your point about a loan mod, in servicing, there's something called a waterfall. And so it's just like option 1, then option 2, then option 3, and you kind of go down the list. And so obviously reinstatement is, hey, make a lump sum payment. So all servicers pretty much went out and said, you know what, we'll give you 3 months and then come back to us 30 days before the 3 months is up, and then we'll talk about next steps. And the first payment option, which would be the best, is just pay everything off in a lump sum. The next thing down typically is, all right, well, let's do a flexible payment. So we'll make up your last 3 payments over the next 3, 6, or 9 months and get you current. Then you get into loan modifications. And so one of the efforts, the lobbying efforts that the Mortgage Bankers Association is doing on behalf of the entire industry is they're trying to get what's called the secretary lien balloon payment that gets tied to the end, which is payable upon payment 360 or payoff. They're trying to get that moved up in the waterfall to be, officially one of the first or second options. And then beyond that, if a borrower is in forbearance, they're trying to get FHFA to basically program DUNLP and allow borrowers to refinance out of forbearance, even while they're still in forbearance and not current. And but those are all efforts that are ongoing. And again, I mean, we know what forbearance normally is like. After a borrower comes out of forbearance, then 12 months later, then they're eligible for a Fannie Freddie loan. So and that's if it gets reported as forbearance. And so there's a lot of uncertainty and there's a lot of efforts. My understanding is from the FHFA, that's just like their top 1 or 2 priority is trying to create some certainty and come out with some clarification on how these borrowers are going to refinance later. They could do a CARP loan. I joke on my LinkedIn videos about the CARP loan. CARP rhymes with HARP, in the CARES Act refinance program. Maybe they create something like that. Fed and Treasury want to get their money back, so maybe they create this loan. I joke about it because the carp is a big, stinky, nasty fish for those of you that ever go fishing. And that's exactly what this forbearance bomb is on our industry. It's just a big, nasty, stinky fish bomb. But, look, there is a lot of uncertainty around credit reporting and then refinancing these borrowers later.
Kevin, I mean, we're confused. We're in the industry, right? We're supposed to be the professionals. Can you imagine what the consumer's going through right now? not really which way should they turn is the problem. They're looking to us and we don't have the answers. Just like, right, we're throwing this around right now amongst each other and we don't even know the answers.
Yeah, and they're talking to one of 5,000 new customer service agents that just got hired and trained to be the expert at their servicer to explain them this process through some script they probably have trouble reading. I mean, it is, it's a very difficult situation. And then to make matters worse, you get the heavy-handed, regulators in some states that are coming down on servicers and, saying, well, you aren't saying the right things to our consumers and, you can't press, the lump sum payment as the one and only option. You can't discourage people. I mean, it's there's a lot of uncertainty, but again, I mean, like anything, over time, we'll get more clarification from the regulators, hopefully not through enforcement action or fines, but then we'll, be able to, tell the consumers what to do in a more educated fashion.
Yeah, but you're doing the right thing. I mean, you're out there every single day on LinkedIn and social media, which I love. I mean, we're competitors, right? But we're friends. And at Redmond Wholesale, we're kind of doing something similar to what you're doing, but the education is amazing. I mean, I love watching you every day.
Thanks,
Great
man.
feedback. Yeah.
Well, I'd much rather be at like an event in Vegas at a bar having a toast with you, but
or on Bourbon Street, New Orleans.
Yes.
That's what I love about all this spirit of we're all in this together. We're all working together. We're competitors, but we're not really, because there's tons of business and plenty to go around. So we all help each other and support each other through this crazy.
For a long time to come. Many, many months, we are going to be so busy and so fat and happy, it's not even funny. So, and Kevin,
yourself, David.
Kudos for coming up with a carp instead of a harp loan. You get it. It's carp. It's all you, bro.
So we've said the word servicing over and over again. So let's talk about that little Jim for a moment. So as we've all heard, the FHFA had really done nothing to help the servicers other than finally clarify that they have 4 months max on the number of the amount of time they're going to have to cover the expenses. Is there any movement on that you're seeing? I mean, everybody is shouting from the rooftops that this is a problem, and still we have no resolution that I've heard of. Are you hearing anything else?
I'll just throw in that, I mean, that is a big deal. I mean,
a big deal. The biggest deal.
It's huge. I mean, I will defend the FHFA here. Okay, just for one.
Wow. Okay.
Yeah, and I know it's
can't wait.
But so we are an experienced servicer. We don't have a huge book from the past, thank God, because this would be a much bigger problem to deal with. But we're very heavy in Texas and Florida, which thankfully are the two least states hit by jobless claims. And so I don't know if it has something to do with the weather or the coastal cities or the space, but
or the fact that their states didn't close them down quite the way we were closed down in California. But anyway, go ahead.
I guess,
I heard some anger in there.
Yeah, I know.
No, not at all.
I
need a pedicure badly, but no anger.
Well,
go ahead.
Is that we've dealt with hurricanes in both states in the past. And so when you have a FEMA declared disaster, like a hurricane or tornadoes or straight line winds, like all the unfortunate storms that have been hitting, South Carolina recently, which is terrible. Definitely thinking about, those people. Fannie Freddie will institute a forbearance. Say, okay, Hurricane Irma, forbearance, 12 months payments. And so what we noticed, especially on our Ginnie Mae book, is these borrowers that opt into forbearance tend to have a higher propensity to default, almost double what the normal default average is. So let's say if we're at 2.5% normal book defaulting, in the state of Florida or Texas on Ginnie Mae, FHA via USDA loans, mostly FHA, it will likely double if a forbearance event happens. And servicers have to pay for 12 months of payments, Fannie and Freddie, when it's a forbearance because of a natural disaster. If there's no natural disaster and someone just doesn't pay, like they're just defaulting, for whatever reason, divorce or lost your job, Fannie Freddie servicers are normally only responsible for 4 payments. And then those loans get taken out of the Fannie Freddie pools, and then they go into default servicing. So what was interesting is when the FHFA said, okay, we're going to step in and not treat this like a typical forbearance. We will take over payments 5 through 12 if it gets that far. So it was twofold. So it was nice to bring some certainty on the exposure. So now all the servicers redo all their models. Okay, I only have to pay 4 months payments, advancing principal and interest. I may have to do 12 months of taxes and insurance because that's not covered, which is separate, and that is significant. It's to the tune of $1.5 billion a month. And then they model that out, and now there's more certainty. And so it's not the best answer, but now there's more certainty. So basically, the other part of that is FHFA said, well, look, if you had a default for any reason, you would have had to pay this anyway. So are you not capitalized enough to do this? Maybe you shouldn't be a servicer, which has been kind of their stance all along publicly, especially as it relates to non-banks. And we're pretty sure all the banks, which service about half of, I think the top 20 servicers service 2/3 of all loans. Half of that is bank and half of that is non-bank. So 10 and 10. So 10 banks are good, they're capitalized, they have assets they can borrow against with Fed cheap money at 0.1% or 25 basis points or less. So they're good. It's the non-banks that have to go out and get money. And there's no coincidence that a large servicer like Mr. Cooper went out and got $850 million from some other lenders right after FHFA announced this, hey, we'll take over payments 5 through 12. So it actually did bring certainty for smaller IMBs with large books that are over leveraged. They may not be as well capitalized or have as good a balance sheet to go get financing. So the whole thing is, please, Director Calabria, you have access to $240 billion credit line from the Fed and Treasury, who has been taking all of Fannie and Freddie's money since the crash anyway. So can you just say, do what Ginnie Mae did with the PTAP, just say you'll have a liquidity facility in case people need it. Just the fact that they would say that would bring so much more certainty.
Right.
Not that they actually give it. And that's kind of what everyone keeps lobbying for, which is when you see the negative press against Mark Calabria and the FHFA, it's like, it's so easy for you to just say, hey, just offer this. But, you know, he's kind of like, well, look, I'm trying to manage this Fannie Freddie entity, which I'm acting as if I'm private and we're taking it private per the direction of my administration, which he was tapped by Vice President Pence to be in his position. So he's acting upon, you know, the principles that he was chosen to uphold. So now it's kind of forced everyone to sign these petitions this week, this Mortgage Action Alliance, and go back to Congress and write your senators and congressperson and say, look, Congress wrote this CARES Act, so maybe we're barking up the wrong tree asking for liquidity from FHFA. We need Congress to act and say, hey, Fed and Treasury, you know, put $30 billion out there for us to use so we can bring certainty for the forbearance problem, get back to doing new loans, get back to doing cash outs, get back to doing stuff, and let's crush it because there's $5 trillion eligible for refinances right now.
Right.
Yes.
Well, okay. So again, the models are all predicated on the idea that you're not going to have an open invitation by the federal government for people not to make their payments, right? And so, of course, you know, under normal circumstances, most servicers can handle, you know, the average number of forbearance requests that they receive for 4 months, but not when you ask, you know, tell everyone you can have one just if you want one, and then 6% of the servicing portfolio comes up to the plate and says, me, please. So, I mean, I think they're totally separate issues, but I've never heard anyone try to defend them before, Kevin. That was really impressive. Good job.
Well,
Nicely done.
They have done some things well. I mean, there's almost 4 million people in forbearance now, and we were looking for market stability. So the I second Kevin's comment. You know, they have done some good things. That's
good. I mean, it's good to hear another perspective, stability. And you're right. At least people can keep their houses for now. That's my concern is down the road.
Right. Yes. They've done it with the FHA. FHFA's done it. They've given stability to servicing group through this avenue, and they did it for Fannie Freddie in terms of buying loans in forbearance, whether it be 500 basis points or 700 basis points, but at least there's stability there, and that changes a lot. You know, the market's just looking for stability. Lenders are looking for an out, even if it costs 500 or 700 basis points, that's worth it, you know, for purchase and rate and terms, you know, so they're getting there. There's a long way to go. There's a lot of questions that need to be answered, but it's the market stability has brought, you know, the warehouse banks have, we haven't even talked about warehouse banks, but they've calmed down because of this stability. So, you know, there's not you don't hear that as much on the warehouse side of banks getting nervous and threatening to pull credit lines from independent mortgage bankers like us.
Calls, from investors as well.
Correct.
So.
And more data is forthcoming. That's the other thing. It's like, you know, Dr. Calabria, you know, he came from the Cato Institute. You can look him up and you can see some videos from the past. You know, these guys are very thoughtful at the FHFA, and they're watching the data. Now, you know, it's subject to change. And, you know, if anyone's a Keynesian economist, which, you know, he might be in that kind of vein, you know, your course changed when the facts change. And so, you know, their original public statement was, yeah, we only think 1 million borrowers are going to go into forbearance. Well, it's a lot more than that now.
Right.
And at 3.8 million borrowers through, I believe it was April 29th was the Black Knight data I saw. You know, we're at 7.5% forbearance, 10.5% in the Ginnie book, and you're around 6.5% on the Fannie Freddie book. And now what's interesting is, being in forbearance in April, did those borrowers then make their payment and think otherwise, or did it stay kind of heightened? And you know, I was on an MBA call yesterday, and the term that was used was, there's a sizable minority of borrowers that went ahead and made that April payment. So that would reverse some of the borrowers in forbearance. But this May 1st print, okay, this May 1st payment, this data is the one that's very interesting, because someone hanging on March and April without a job is way different than someone hanging on March, April, and May. And so
right.
This new wave of data for the May payments coming in is going to be a very big telltale sign. And it's no coincidence that it's 3 payments. And most of the servicers were only offering at first initially 90 days worth of forbearance before extending the other 90 days. Because if you remember the CARES Act, it says you were eligible for up to 180 days of forbearance. Then, if you still need it, you're eligible for up to another 180 days. But the servicers are doing 3-month and 3-month blocks because they don't want to put themselves out for that long. They're trying to pull these borrowers back in before they let out too much slack, and they can't ever reel them back in. So I think this month is so critically important to see what actually happens. I mean, and again, economies are reopening. That doesn't mean people are getting their jobs back, especially at the lower end of the income range and in service and hospitality, who aren't necessarily mostly homeowners. So I have to think, and I'm very hopeful, that the intelligent people at Fed, Treasury, and FHFA are watching this data like a hawk, and they're trying to see what the exposure is, and they're trying to see, okay, if we have to make another move, let's see what the data forces us to do, and then rethink our calculus.
Okay. Well, and this is another opportunity for loan officers to get back to their clients, because I had a conversation with some people yesterday that I had spoken to 2 or 3 weeks ago. We had agreed that the best way for them to go is to make their April payment and then see how it goes in May. We just had a conversation yesterday, and they were asking about how, you know, they said, we don't have enough money to make our payment plus pay off our credit cards like we do every month. And I said, well, this is the time, make the minimums on the credit cards, and you make your mortgage payment. And so we had that agreement. So again, that's where you are better than a computer when it comes to somebody going to get a loan, because you can give them good advice. And so my invitation to them was, you call me as often as you need. This is a fluid situation, and we will just keep making these decisions, and hopefully we can keep you current on your mortgage, because they really need to refinance eventually. So anyway, all right, so moving right along, that is a lot. I love that there is some positive spin around the whole FHFA situation. You guys are the first time I've really heard anyone feel like what they've done has been positive and good. And so the takeaway as always is stability, right? We need some sort of idea of what our worst case scenario might look like, and then we can live with that, right? We'll model around it. Right. So they're asking, we're going to go to some questions. So they're asking, are there any hits on FHA and or VA cash outs? Is that an issue?
There are no hits.
I'm seeing shaking heads. No hits on FHA or VA. That's good news. All right. And somebody said, and I think we know the answer to this, why are credit reports now showing or stating this? Affected by natural or declared disaster, does this have anything to do with forbearance? And the answer is probably yes. Yeah. Yeah. I heard of somebody who had clicked on the button on the, well, I'm just going to say it, on the Wells Fargo site, just because, do you have questions about forbearance? They clicked yes. And then 2 weeks later found out that they couldn't make their payment because they had been put into forbearance because they had clicked on the button. So again, really important for people to understand that they have to really be asking a lot of questions. Let's see. Oh, wow. Okay. Somebody's asking if they can intervene as a realtor and renegotiate the terms. I'm assuming they mean I don't know what they mean. The terms of realtors shouldn't be negotiating anything for anyone at this point. Is that a fair thing to say?
Or a realtor is not
LOs.
licensed mortgage loan originators. But if the realtor is also a mortgage loan originator and they want to step in and talk, I mean, now we're talking about, like we did before, loan mods. And so as long as they're not asking for an advance fee, but because they're in this world and they understand the terms and the verbiage we use, sure, they can do that. But yeah, that if they're just a realtor, and I'm not saying that in a negative sense, if that's all they're licensed to do, they shouldn't be talking about mortgages with people.
Let's see. Okay, so there's some opinions. Why is cash out the target and not low credit scores or high LTVs?
Yeah, I'll answer
question.
that. Yeah, I mean, I think, cash out has always been one of the higher risk loans because they're literally just, it's not equity in the house. They're just taking their cash. And in times like this is when people take their cash and run. Like, you know what? I'm just going to tap out, take my cash. I'll take the foreclosure. I got enough cash to get by. I now get 12 months where I don't have to make a payment. And then when that thing starts all over again, then the foreclosure process starts. I'm still not making a payment. Maybe they're still working and they've taken cash and saved money. And then, before 2 months ago, you could be one day out of foreclosure and get a loan at 20% down, or whatever. So cash out has always been kind of one of those risk thresholds where those kinds of things happen. And I think that's probably why that was chosen. It's not equity in the home. It was, rate and term is less risky to a lender or to Fannie and Freddie because, you're not walking away from your equity in your home. But if you take cash out from your equity in home, that's when you want to walk away. It's like a strategic default. And so we're back to that kind of decision again.
Yeah, it's called, there's a term called equity stripping. So they're equity stripping and effectively increasing the LTV of the loans. And with the housing market expecting to take a little bit of a turn to the negative and housing values to drop a bit, you're just increasing the LTVs overall. So they're trying to prevent that from going on.
And that explains why all the, this is Kevin Casey, by the way, that explains why the equity line lenders are shutting down now.
Right. Yep. Yeah.
Pulling back at least.
Great recall of the term equity stripping. I hadn't heard it since 2009 when I was running a team in South Florida and we saw tremendous equity stripping.
PTSD, Kevin, PTSD.
Yeah, right. Thank you.
Yeah.
The HELOC thing is a little different animal because you're in second lien position. So, at least with a cash out, typically max LTV in most lenders is 80%. There's still equity in there. But HELOCs aren't even in first lien position. They're a second lien, they're a senior lien. And the reality is there is uncertainty around whether we will see price and value depreciation, where we would see the values of our markets, and some markets might see it. Some of the larger markets that are harder hit might see. Let's just say the Bay Area, for example. Not to pick on you, Audrey, but there are larger loan amounts.
Careful.
I know, right? They're larger loan amounts. They're beyond. They're well beyond even the high balance loan limits. Those are mostly jumbo markets, which jumbo products have been pulled for about a month with some lenders, okay? So there's less lending on the higher end. And then if you're a HELOC in second lien position, taking out equity on a jumbo home appraised value, your second lien loan amounts are larger, and therefore you have even larger losses in those markets and still being in second position. And so there is true uncertainty whether we're going to see home values come down, nationally. Will the HPI home price index come down nationally? There's going to be some pockets where there will be less appreciation for sure. It just depends on how quickly we snap back this summer with refinances and purchase money to hold that HPI in each different market.
Well, one of the things we all keep talking about is how we're in such a different situation going into this than we were in bad times. And the fact, like for instance, the house around the corner from me just went into contract, 8 offers, and it's all jumbo. And so there's still a limit on housing and in these areas. So it is going to be interesting to see what happens. And people are asking about jumbo lending right now. So let's talk about that. So jumbo lending, as you're seeing it, tell us. We know that the LTVs are lower, the scores are higher. What's your feeling about the upcoming weeks and months in jumbo?
I'll jump in. Go ahead. No, go ahead. Go ahead. I already spoke last.
No, it's fine.
Well, I was just going to say, jumbo lending is a balance sheet play. So banks use their cash on hand to lend money out for a jumbo loan, and then they hold it, and there's an asset which hopefully doesn't depreciate in value, and then they take that security to market in what's called a non-agency MBS. So these are not mortgage-backed securities traded in the universal mortgage-backed security, formerly known as Fannie Freddie coupons, or Ginnie MBS. These are complete balance sheet plays by banks and even some non-banks that were doing it. Now, is that the best use of their capital when the risk is much greater? There's an old adage in our industry. It says if you have a $100,000 loan, you have a problem. If you have $1 million loan, the bank has a problem. And so when you see that the banks, who are really the main source, certainly they have the cheapest cost of funds, with Fed funds rate being in that 0 to 0.25 range. It's basically they're lending at 10. They're very able to borrow at 10 basis points. So they have the cheapest cost of funds. Now, Audrey, you talk about a jumbo loan with 8 offers. I wonder if all 8 of those offers have a 120-day contract written, because the jumbo loans.
No.
Yeah, because they're not closing in 30 days. I don't know any. I don't know any bank. Look, there might be some, but I don't know any of the major banks out there, Union Bank, Chase, Wells Fargo, who haven't cut this product out for their own retail channel, by the way.
Right.
They are at extended underwriting turn times. And that's just going to be the name of that game for a while. So what happens is when jumbo lending contracts, because we have a liquidity crisis in our industry, because there's uncertainty around home price index, there's uncertainty about 30 million jobless claims and how it's going to impact consumer demand for housing. And there's uncertainty about this forbearance bomb. And there's all the aggregators and non-banks who usually buy loans from lenders like mine and lenders like Carl's and lenders like Jeff. They aren't lending as much. And so, I'll say one more bad thing about my own company, and then I'll kind of leave a little bright spot of hope here, is that, like in our wholesale channel, we sold 3 different jumbo loans to 3 different places, and all 3 of them.
Oh, what happened to Kevin?
Did we lose? We lost Kevin?
I'm sorry.
There we go.
Anyway, what I was going to say was, we sell in our wholesale channel, our non-doc core channel, we sell to 3 different places our jumbo loans, and all 3 of those places basically said, look, if you sell us a loan and it goes into forbearance, even 4 months after you sold us the loan, we will make you buy it back because the borrower's not paying. Now, we're not going to take that risk. We're not a bank. That's not the best use of our capital either. And so, unfortunately, in my TPO channels, I have no jumbo product. Now, in my retail channel, I have 1. I actually have two. The other one shut down so far. It's like max 65% LTV. So so look, I mean, the jumbo landscape has helped, and that's a sign of liquidity. But what I'll leave on kind of a good note for this came into this crisis with a solid financial system. The banks are solid. Their balance sheets are as strong as ever. We came into this with the housing industry absolutely strongest, arguably it's ever been. And there's been a lack of housing supply. And now we have the lowest interest rates in history. And so what's crazy is, if we had just gotten this certainty from the FHFA so quickly like we did from Ginnie Mae, we probably would be able to have just as quick snapback rebound from a lending and liquidity perspective. Jumbo is a little bit different.
I think we're losing Kevin.
Kevin, we're losing you, Kevin. So I don't know why you're fading in and out, but for the rest of you, what if you were to give advice to people about what to do with their jumbo borrowers right now? What is your advice? What are you telling people?
Yeah, so I think I know where Kevin was headed with this too. So there were jumbo lenders, some were banks, some were aggregators, right? So the aggregators, their execution strategy was to aggregate large pools and securitize those into the secondary market. Much like 2008, different reasons, but much like 2008, the secondary market has gone away for a little while. There is no private label securities going on. So those lenders like Redwood, for example, have stopped lending. So what's left are the banks, and the banks don't want to buy or didn't want to buy 100% of the jumbos that are out there through third-party lenders or even through their retail channel. So some have cut off completely from jumbo, and some have just said, okay, we'll just buy, but from our own retail channel, and that's it. They want to limit the amount of these loans going on their balance sheet, because they're concerned about housing prices, or they're concerned about forbearance, concerned about credit, concerned about people losing their jobs and what their delinquencies. So they're just going to take a step back and say, we're going to limit the amount of risk we're going to take, especially to a large loan amount. So that's why that market has really shrunk. There still are a few portfolio lenders out there buying from third-party lenders like us or through their retail channels. There's a handful. They've obviously trimmed their guidelines to where they're doing 80 LTV max or 720 score and up. The credit box has shrunk, rates have gone up. There's, like I said, but there are still a few out there. It's going to take a little while for the banks to step back in. The secondary market for those aggregators is going to be a little bit longer. It should come back because this isn't a credit problem, it's a liquidity problem. So once it starts coming back, I think maybe the latter part of this year, early next year, the secondary market comes back, and that stands for, not just jumbo, that's the other programs too. That's non-QM. Non-QM didn't leave because it has a credit problem. It left because it has a liquidity problem. So once that comes back, I'm thinking end of this year, early next year, we may not see exactly the same products we saw as early as a month ago, but those programs should be back in full force.
Do you think jumbo is going to take that long to come back, huh?
I do.
Okay.
It's going to take a while for, you're going to see massive drop in GDP. You're going to see the jobs number coming this week on Friday is going to be horrendous. You're going to continue to see unemployment claims. The economy is not going to get back up to anywhere near full speed for a long time. So, until that happens, people aren't going to want to put money to work just yet. Especially, the stock market's doing well, although it seems to be a little bit fragile. So I think cash is king, and they're going to keep money on the sidelines for a little while longer. See where all this goes.
That was a good question, because we probably didn't introduce ourselves in the beginning, but I head up sales with Redmond Wholesale, and Jeff is actually our capital markets guy, so he's been around for a couple of years. Good insight.
It's great insight, and I guess I didn't really go into the introductions in depth because I assumed everyone had read the flyer, and I apologize. Yeah,
this is what Jeff does every single minute of every single day, so he has Terrific.
I've been doing this since the late 80s, so we've seen a few market changes. Like I said to Kevin earlier, we all went through 2007, 2008. So, we're seeing similarities in terms of liquidity, but it's for obviously very, very
Different reasons.
Right.
Yeah,
So
agreed.
we're getting a lot of questions about David's original comments about the possibility of being able to waive 3-day rescission. So of course we're LOs, so we're like, waive rescission? Really? How? So can we go back to that for a moment and see if anyone has anything else to add to that conversation, or whether we need to just wait and see what else transpires because it's too early?
So just for the people that jumped on late, the CFPB says that they are issuing an FAQ document that addresses the rule, the TILA-RESPA TRID rule, and more specifically TILA. So my question, seeing that I don't know if we still have Kevin on, maybe he can just jump in with either a yes or no, but Carl, would Remen allow a borrower to waive rescission because of this national pandemic, or are we still going to require that they wait the 3 days?
I think it's too early right now. I think we're going to have to follow, obviously, the issuance, but I think right now we don't have any guidelines to even follow at this point.
Yeah, and I would just chime in that we're not allowing that waiver for that 3-day at the moment, and I think mostly because, and I hate to say this, but it's just a thought, and this isn't our official stance, just thinking out loud. If someone's asking for a waiver, I'm probably concerned about them having a job or a job issue or being a borrower likely to go in forbearance. And so, I know that waiver has always been there, that you can waive that 3-day wait period in case of an emergency. And for at least the clarification for them to come out and say a COVID-19 emergency is a bona fide emergency, which allows them to have that waiver. I don't know if that means we have to allow it. I don't know. We're still doing some research as well, but I would think that's probably not in the borrower's best interest to be rushing things, especially if there's no reason to rush. I don't know.
Well, I'm just going to speak for the borrowers that I speak to. Speak for the borrowers I speak to who say, I have to wait 3 days and then I have to wait another 3 days. What? So they totally don't get it. So yeah, it'll be interesting to see this play itself out. Okay, why did FHA pricing get a lot worse compared to 30 days ago?
Servicing.
Servicing. Okay.
Well, yeah, it's servicing. The servicing market for everything, Fannie, Freddie, Ginnie, it's really disappeared. Independent mortgage bankers, for the most part, sell their servicing, maybe retain some, sell some. We lost, as an industry, we lost most of, if not all of our buyers of servicing, and especially on the government side. There were only, I want to say 5 buyers of servicing on the Ginnie Mae side. They've all pretty much disappeared. So the servicing values, folks that are now forced to retain all their servicing, Homebridge and Remen are one. I believe Kevin's at PRMG is doing the same thing. We're forced to retain all, if not most, if not all of our servicing, and the value of that servicing is unknown. So you had, on average, servicing was worth, call it a point, a month ago, and today it's 0, if not negative. I can tell you, I received a contract, just for real quick, I received a contract from a servicing buyer on the Ginnie Mae side, and the contract read that I had to pay them to take my Ginnie Mae servicing. And they said they're getting companies signing this because A, they can't retain, or B, they don't want to retain based on the unknown, the future unknown of what this is going to be if they have to advance. I know they can tap into the PTAP program and try and get reimbursed for their advances for Ginnie Mae servicing, but there's still so much unknown that it does get expensive. You have to have a lot of cash on hand to retain, especially government servicing, and there's a lot of companies out there that can't do that, and so they're forced. So long way around the answer, but the answer is servicing disappeared. The value of servicing disappeared in your pricing.
Also,
Yeah.
Okay, so
the greatest amount of folks in forbearance are govies. And so on the conventional side, okay, you have a higher than normal percent, but it's not as high as govies. Govies are in double digits. I think it's about 10%, somewhere in that range. You guys can correct me, but it's double digits.
Right.
Yep.
10.5%.
Okay.
And I think that's good color. I would also add that before the forbearance bomb issued, government was kind of looked at as potentially the next loan to really see issues after non-QM. And that was because, since 2008, it's kind of known as, a little bit, as the new subprime. I mean, they go, down, they have no FICO minimum. They go down to 550 at most lenders. So those are the first people typically to have an issue. I mean, it's 635 FICO and under, the servicing performance drops off precipitously. I mean, it's enormous. And so, and then you have a prepay issue. I mean, you're going to do a loan for an FHA bar at 3.75%, and then they can turn around and refinance, in a couple months. So now you have a prepay issue, right? You also have a capacity issue. I mean, if the going rate is 3.25 right now, there's $5 trillion in loans eligible for refinance. This industry doesn't have the capacity to do it all in 30 days. So to push back the volume, there's even a little bit of artificial inflation in the margin, just so lenders don't blow themselves up and take on too much business. And so there's a lot of factors all coming into play. And I agree, Jeff and Carl, I mean, I would say at the end of last week, we started to get some less offensive bids. But yeah, I saw MSR valuations since the middle of March, basically at zero. And like you said, some are negative. And it's like the aggregators are looking for lenders who are desperate that can't service. And that's not your companies. That's not us. But, there's some out there. Choice,
Wow. All right. So we're getting to the end, guys. I'd like, let me just give you a chance, 30 seconds. Jeff, what's coming up next week? Anything that's on your radar that you'd like to share?
No, just looking for more market stability. From a capital markets side, the market itself has stabilized. The big issue around margin calls seems to have waited or seems to be gone. You have a jobs number this Friday that's going, like I said, is going to be horrendous. The Fed already said that they will continue to purchase mortgage-backed securities forever, basically. Keep rates low for the foreseeable future until they start seeing some more movement in the economy. So, rate stability, market stability. I think we're in a decent spot right now in terms of mortgages, and I think it's going to be here for a while. So it's just again, it's to see how many forbearance loans, what's the speed. As a company, we're adding a couple of hundred a day of loans in forbearance. So let's see when that, we keep talking about flatten the curve with COVID, but we're talking about flattening the curve on forbearance too. When does that kind of peter out and go the other way? So we're all looking for that, but I think it's market stability for the next 30 days.
Great. Carl?
Yeah, Audrey, I'd just like to add something for the loan officers out there listening, and that is to make sure you're setting proper expectations. As lenders are out there, right, we're all getting squeezed. All this business is getting squeezed to our books right now, and turn times are expanded. Pricing, obviously, like Kevin talked about, they're inflated at this point somewhat, but setting proper expectations, you're not going to get an approval the same day or the next day today because there's just too much volume out there for all of us. It's really important. I'm on the phone every single day with loan officers, brokers, processors out there, and that's the biggest issue I hear right now is they're locking loans for 15 days, and there's no way a loan is going to close in 15 days unless it's a perfect situation. And turn times set your bars up to win, and it's not going to take. It might take a few days for an underwriter to get to that file to approve it. So that's my advice to everyone right now is better to tell them it's going to be a week out and have it take 4 or 5 days than the opposite.
That's great advice. Kevin?
Yeah, I love all those comments, and I hope my audio isn't too poor sitting back here in my house hiding from my children. 7, 5.
You sound great.
Okay, good. Look, even if we hit 20% unemployment, we're at 80% employment. So go find the good deals that are out there. If a borrower talks about forbearance in process on a new loan, say, you know what? Yeah, come. You have as an originator, when you have a license, you have a fiduciary responsibility to make sure that they have the ability to repay ATR, and that there's continuity of income. Just say, you know what? Come back to me in a couple months when you get your stuff in order. There'll be plenty of time to work on these lower interest rate loans, and there's plenty of business out there to go get. You know, I don't know if anyone ever watched the movie Colors, and this is where I would tell the story about the Papa Bull talking to his son bull and all the cows down at the bottom of the hill. But let's walk down there and get these loans. We don't need to rush into anything. We're going to have interest rates for a very, very long time, at least for the foreseeable future at this low rate. And there's plenty of good business to go get, despite all the crazy turbulence. And thank you, Audrey. Thank you, Jeff. Thank you, Kevin. Thank you, Carl. Thank you, David. I really appreciate being on this call with all of you. This has been great.
Yeah, you guys, I can't thank you enough. Dave Luna, I am going to have the pleasure of talking to you again in the next few days. Look for our upcoming events. We have plenty of them on the horizon. I'm going to wrap this up because we are over time, but you are all just a wonder of information and industry knowledge. So thank you very much, and have a great week. And it's all going to be okay, guys. We've been through this before. We're going to come out on the other end and be high-fiving each other at live events eventually. All right, with that, have a good evening, day, week.
Thanks, everybody.
Bye.
Thanks, Audrey.
Thank you. Bye.
Yeah, thank you, Megan, for setting this up as well. Thank you.